Most people think portfolio construction is about finding the right assets. Stocks versus bonds. Real estate versus commodities. Active versus passive. They argue endlessly about instruments while missing the more uncomfortable truth that Lucas Snopek places at the center of this book. Portfolio failure is rarely caused by bad assets, but by bad thinking under uncertainty. The real subject of portfolio construction is not finance. It is human behavior confronted with risk, time, and ignorance. The book opens quietly, almost politely, but its implications are brutal. Before you can talk about returns, you have to talk about inflation. And inflation is not just an economic concept, it is a psychological trap. It silently erodes value while rewarding inaction with the illusion of safety. People believe holding cash is conservative. In reality, it is a guaranteed loss disguised as prudence. Inflation punishes those who confuse stability with protection. Here is an uncomfortable question most investors never ask themselves. If inflation is always present, why do you still treat cash as neutral? Because cash feels safe. And feeling safe is often more important to people than being right. From the beginning, Snopek forces a shift away from moral language, good investments, bad investments, and toward probabilistic thinking. Every asset carries risk. The difference is not whether risk exists, but how visible it is. Stocks fluctuate loudly. Inflation destroys quietly. Bonds default rarely, but when they do so catastrophically. Real estate feels solid until liquidity disappears. The danger is not volatility, it is false certainty. Risk, as the book insists, is not a single number. Volatility is only one expression of it. Standard deviation measures how much prices move, not how much pain an investor will feel. Beta compares assets to a market that itself may be mispriced. Value at risk gives false comfort by assuming normal distributions in a world that regularly produces extremes. The shocking realization is this: most risk metrics exist not to protect investors, but to make risk appear manageable. Ask yourself something difficult. Do you actually understand your risk, or do you just recognize the numbers you've been taught to trust? Snopek does something rare here. He does not attack financial theory. He exposes its limits. Modern portfolio theory assumes rational investors, stable correlations, and measurable distributions. Reality offers none of these consistently. Correlations spike in crises. Liquidity vanishes when it is most needed. And investors, under pressure, do not behave like equations. The book's strength is that it refuses to isolate markets from psychology. Investor behavior toward risk is not linear. People are not risk-averse or risk-seeking in general. They are context-dependent, emotional, and deeply inconsistent. The same investor who avoids small losses may take enormous risks to avoid admitting a mistake. Loss aversion does not mean avoiding losses, it means avoiding the feeling of loss. This is where portfolios really fail. Not when markets drop, but when investors panic, freeze, or overreact. Uncomfortable question: if your portfolio dropped 30% tomorrow, would your reaction improve or destroy your long-term outcome? Most people overestimate their tolerance for drawdowns because they have never experienced one in real time. Paper losses are abstract. Real losses trigger identity threat. The book then moves through asset classes not as shopping categories, but as risk containers. Money markets feel safe because they are liquid and familiar, but they are exposed to inflation and policy manipulation. Bonds appear stable, but they are hostage to interest rates, credit risk, and duration, risks most retail investors barely understand. Stocks are engines of growth, but they are vulnerable to sentiment, cycles, and overvaluation. Real estate concentrates risk geographically and politically. Commodities swing violently and require timing discipline most investors lack. Private equity locks capital away and demands patience few possess. There is no safe asset. Only different ways to be wrong. This leads to a critical insight that many investors resist: diversification is not about owning many things. It is about owning things that fail differently. And even that is conditional. During crises, assets that were diversified suddenly move together. Correlation is not stable. It is emotional. Think back to 2008. Or 2020. Or any liquidity shock. Diversification works best in calm markets, and is most needed when it works least. So why do people still believe in simple diversification narratives? Because they want certainty in a probabilistic world. The book dismantles the comforting myth that markets are always efficient. Weak, semi-strong, strong efficiency, these are frameworks, not laws. Information is uneven. Incentives distort behavior. Psychology creates momentum, bubbles, and crashes. If markets were perfectly efficient, there would be no excess returns, no anomalies, no recurring behavioral patterns. Yet history is full of them. The deeper point is not that markets are inefficient. It is that markets are human systems. This is why the book places fundamental analysis, technical analysis, and psychological approaches side by side instead of treating them as rival religions. Each captures a different dimension of reality. Fundamentals describe value. Technicals describe behavior. Psychology describes error. Ignoring any one of these makes you blind. Uncomfortable question: are you investing based on reality, or on the method that best matches your personality? Many investors cling to one approach not because it works best, but because it feels familiar. Value investors ignore momentum. Technical traders ignore valuation. Long-term investors ignore timing. Each camp defends its narrative because abandoning it would mean admitting uncertainty. Snopek's refusal to crown a single correct method is unsettling. He insists that markets are shaped by multiple forces simultaneously: macroeconomic conditions, fundamentals, technical patterns, behavioral biases, and plain luck. Any model that ignores one of these is incomplete. Luck is especially offensive to investors. They want skill to explain outcomes. But luck matters enormously, especially in short and medium timeframes. The book does not use luck as an excuse, it uses it as a constraint. You cannot eliminate randomness. You can only design portfolios that survive it. Survival is a recurring, understated theme. Before optimizing returns, you must ensure durability. A portfolio that collapses under stress is not aggressive, it is fragile. This is where risk management enters not as a formula, but as a discipline. Protecting capital is not about avoiding losses entirely. It is about avoiding irreversible losses. A temporary drawdown can be recovered from. A permanent loss of capital cannot. Uncomfortable question: does your portfolio protect you from volatility, or does it protect you from ruin? The book's discussion of behavioral finance is particularly sharp. Biases are not academic curiosities. They are structural vulnerabilities. Overconfidence leads to concentration. Confirmation bias leads to ignoring warning signs. Herding leads to buying peaks and selling troughs. Mental accounting fragments portfolios into emotional compartments instead of coherent systems. Perhaps the most dangerous bias is illusion of control. Investors believe that because they can trade, analyze, and adjust, they are in control. In reality, most of the forces that move markets are outside their reach. The sense of control often increases risk rather than reducing it. This leads to one of the book's most sobering implications: doing more is often worse than doing less. Frequent trading, constant optimization, and overreaction to news feel productive but usually erode returns. Costs, taxes, timing errors, and emotional decisions accumulate quietly. Ask yourself something honest. How many of your past investment decisions actually improved outcomes, and how many simply satisfied your need to feel in control? The book does not argue for passivity. It argues for intentionally. Every action should serve a clearly defined role within a portfolio structure aligned with life objectives, time horizon, liquidity needs, and psychological tolerance. This is where portfolio construction stops being theoretical and becomes personal. A portfolio is not just a financial object. It is a behavioral contract between you and your future self. If that contract ignores who you actually are under stress, it will be broken at the worst possible moment. Portfolio construction is not about predicting markets. It is about designing systems that function when prediction fails. And prediction always fails eventually. Once the illusion of prediction collapses, portfolio construction becomes something far more uncomfortable: a discipline of self-constraint. Most people want portfolios that maximize returns. Snopek insists on something far less seductive but far more important: portfolios that remain intact when the investor is no longer rational. This is where the gap between professional thinking and retail behavior becomes obvious. Professionals assume markets will surprise them. Retail investors assume surprises are temporary exceptions. That single difference explains most long-term underperformance. The book forces a brutal reframe: your portfolio is not tested when things go well. It is tested when everything you believed about risk, diversification, and valuation appears to fail simultaneously. Think about every major crisis. Correlations spike. Liquidity disappears. Safe assets behave strangely. News becomes emotionally charged. And at that exact moment, investors are asked to do the one thing human beings are worst at doing: nothing. This is why Snopek emphasizes process over brilliance. A portfolio built on intelligence but lacking discipline is fragile. A portfolio built on clear rules, limits, and expectations can survive even mediocre decisions. Here comes an uncomfortable question most investors avoid: if markets behave irrationally longer than you expect, can your portfolio survive your own impatience? Time horizon is where this question becomes lethal. Most people claim they are long-term investors. Very few actually structure their portfolios as if that were true. They say long-term, but they check prices daily. They say I won't panic, but they have no predefined response to drawdowns. They say I can tolerate risk, but they've never defined what risk means in their life. Snopek insists that risk tolerance is not a personality trait. It is a situational constraint. It depends on income stability, future obligations, liquidity needs, age, family structure, and psychological resilience. Ignoring any of these turns theoretical tolerance into fantasy. This is why the book ties portfolio construction directly to life objectives. Not abstract goals like growth or wealth, but concrete realities. When money is needed, in what currency, under what tax regime, with what margin for error. Uncomfortable question: if your portfolio underperformed for 5 years straight, could your life still function? Most investors never ask this. They optimize for upside and assume time will heal everything. Time does not heal forced selling. Liquidity is one of the most underestimated risks in investing. Assets that look attractive on paper become traps when capital is needed unexpectedly. Real estate, private equity, structured products, these can be excellent investments only if liquidity constraints are explicitly acknowledged. Snopek's repeated warning is simple and devastating. Never confuse theoretical returns with usable capital. A portfolio that looks optimal but cannot be accessed when needed is not sophisticated. It is dangerous. This is why the book treats portfolio construction as a sequence, not a static allocation. Currency choice, tax exposure, liquidity requirements, risk proportion, and only then asset selection. Reversing this order is how investors end up with beautiful portfolios they cannot live with. Another quiet insight that changes how you see markets: volatility is not the enemy. Forced action is. Volatility hurts only when it collides with leverage, liquidity needs, or emotional overreaction. A volatile portfolio held patiently can outperform a stable portfolio that is constantly adjusted under stress. This leads to a deeply counterintuitive truth: portfolios often fail not because they are too risky, but because they are misaligned with the investor's psychology. The book does not shame this. It exposes it. Consider two investors with identical portfolios. One understands the structure, accepts drawdowns, and has no urgent liquidity needs. The other watches obsessively, doubts constantly, and panics under pressure. Same assets. Radically different outcomes. So where is the real risk? In the market, or in the investor? This is why Snopek integrates behavioral finance directly into portfolio design. Biases are not mistakes to be corrected after the fact. They are constraints to be designed around from the start. If you know you are prone to overconfidence, your portfolio should limit concentration. If you know you fear regret, your portfolio should limit discretionary decisions. If you know you chase trends, your portfolio should include rebalancing rules that force discipline. Uncomfortable question: have you ever designed your portfolio to protect you from yourself? Most people haven't. They design portfolios to express intelligence, not to ensure survival. The discussion of market timing is particularly revealing. Snopek does not claim timing is impossible. He claims it is incompatible with human psychology at scale. Timing requires being wrong repeatedly before being right. It requires acting against consensus. It requires emotional resilience under uncertainty. Most investors possess none of these consistently. So instead of promising market mastery, the book reframes timing as a secondary tool, something that may enhance outcomes, but must never be structurally necessary. This leads to one of the book's most important distinctions: robustness versus optimization. Optimized portfolios perform well under assumed conditions. Robust portfolios perform acceptably under many unknown conditions. Optimization feels intelligent. Robustness feels boring. Markets punish those who confuse the two. Here is a real example that exposes this difference. Before 2008, many portfolios were optimized for low volatility using mortgage-backed securities and leverage. On paper, risk was minimized. In reality, fragility was maximized. When assumptions broke, the portfolios collapsed entirely. Robust portfolios survived not because they predicted the crisis, but because they did not require the absence of crisis to function. This is the mindset Snopek pushes relentlessly: do not build portfolios that only work in good weather. This is also why the book treats Markowitz, CAP, and variance optimization with respect but not reverence. These models are tools, not truths. Used blindly, they create false precision. Used humbly, they inform better judgment. Judgment is the word most finance books avoid. This one does not. Judgment cannot be automated. It cannot be outsourced. It cannot be replaced by backtests. It emerges from understanding limits, of models, markets, and oneself. By the time the book reaches its own portfolio construction method, something subtle has happened. The reader no longer expects a magic formula. They expect a process that reduces regret and increases resilience. Rules for protecting capital are not clever. They are restrictive. They prevent ruin, not embarrassment. Risk management rules are not about maximizing returns. They are about ensuring you remain in the game long enough for probabilities to matter. The most life-changing realization comes quietly near the end, wealth is not built by extraordinary decisions. It is built by avoiding catastrophic ones. Most fortunes are lost not because of ignorance, but because of overconfidence at the wrong moment. Most successful investors are not smarter than average. They are harder to kill. Final uncomfortable question: is your portfolio designed to impress, or to endure? If you take nothing else from this book, take this: portfolio management is not a battle against markets. It is a long negotiation with uncertainty, ego, and time. Markets will change. Models will fail. Narratives will collapse. The only thing you can truly control is whether your portfolio structure respects reality, including the reality of your own behavior. And that, more than any asset selection, determines whether investing becomes a tool for freedom, or a slow, sophisticated form of self-sabotage.